right, folks. Here we are again. Episode 40. Can't believe I'm even saying that number. Jesus Christ. To denote an episode. Episode 40 came a long way over the past 2 years. Came a long way. Anyway, episode 40 of the ICT Mastery Mentorship. We're going over breakaway gaps. Very, very simple concept. Okay, because I know this concept like the back of my hand, back and front of my hand, if you want to, really just exaggerate it. But this is a very, very easy concept for me at least, because I know it pretty well, I've mastered it. But I'm going to transfer my mastery to you, and you're going to learn breakaway gaps very, very easily. Okay, ready? Breakaway gap. In short, okay, you remember how the market does three things: seek liquidity, rebalance imbalances, or what's the last one? Do you know it? Rebalance to equilibrium. Those are the three things that price is going to do constantly. It's just going to do that. So the first gap that forms before price begins to do one of those three things should stay open. That gap should stay open. You're probably like, what? Shouldn't it fill? No, no. I said this, I think I mentioned this literally 2 episodes ago. If you want to see price go somewhere, you do not want to see gaps fill, because that's telling you that price is really, really eager to reach or to go to or to do whatever it wants to do. It's just basically showing ambition. That's all it's doing. That's all the market is doing when it's doing that. So a breakaway gap is literally what I taught you, I think, 2 episodes ago in the consequent encroachment video, is how you don't want to see gaps get filled, or you would just want to see the gap stay open. Okay, that's basically what the breakaway gap is telling you. Like, this market's showing a lot of ambition. It really wants to do what it wants to do, so trust it. Don't even try to, discourage it. It's going to do what it wants to do, period. That's basically what the breakaway gap does. So we're going to go into a quick example here on Wednesday, 21st of January. Let me see here. I'm going to go to the 1 minute, scroll all the way back. All right, now, breakaway gaps, first of all, before we even dive into this, they're best used with time. Obviously, right? I've taught you this before. You cannot use any of these concepts without time. Reason being, price without time cannot work. You can't just have price and say, oh, this market is great. No, you need time. It's just, if the concept of time didn't exist, you would never even see all these candles. You would just see one candle. Time frames wouldn't exist. So you get the point. Time, you need to have it with any concept on this channel, or that I'm going to teach in the future, okay? But with this specific concept, it works very, very, very well with time. When I say very, very well, very, very well, because the way it's built and the way it functions, it's amazing. Anyway, let's say our quote unquote reference of time is 9:30. Let's just use that nice little time, right? Pretty common. The first gap before this run on liquidity, and you're probably like, where's the liquidity at, JJ? Up here, these equal highs, right there. If I can get it. Oh, look at that. First try. First try. Okay, we're going to mark that as buy sell liquidity, and we're going to zoom all the way back, and here we go. What is the first gap before this run begins? What's the first gap? There's a couple of them. Pick one. I'll give you a hint. It's around here somewhere. It's around there. There's three of them. There's three that you can pick from. 3 answer choices. Reminder. 3 answer choices. All right. Now, if you picked this one, you're correct. If you picked this one, you're correct. If you picked this one here, this very, very small one there, you're also correct. But if you were to consider incorrect answers, you would be incorrect here. On these 2 gaps, you would be incorrect. Reason being, you see how there's an order block that offers sell side delivery within those fair value gaps there? So what's going on here? What's going on? These 2 gaps are balanced. Why? Because you have sell side and you have buy side. So the gap has already been balanced, right? Because reminder, a breakaway gap is a gap that is not supposed to be filled, in which it can be filled in the future once its objective has been completed. That's one thing I forgot to mention too. Once it's done with its liquidity run, rebalance to equilibrium, or rebalance of imbalances, once it's done with those 1 or 3 things of whatever it's doing, it can then come back and use that gap or refer to it or fill it however it wants. However it wants to treat that gap, it can do it once it's done with its, objective. Okay. So since that is the narrative behind these breakaway gaps, is to fill them or to not fill them during the, whatever the 3 things are, or whatever the 1 out of 3 things are. If it's already filled, then it can't be a breakaway gap. right? Because in the future, we're gonna fill it. It just you get what I'm saying here? It's not a true fair value gap. It's not a true fair value gap that's staying open because the fair value isn't even there. The fair value isn't even there. The fair value has already been offered with this sell side delivery here. That's the order block. See this down close candles right here? These two? One, two. Sell side, buy side. So these two gaps are balanced. Probably like, oh, so the real breakaway gap would be which one? That one right there. You're probably like, that's real tiny, JJ. Yeah, I know. But guess what? Still a gap. It's right there. It still exists. So, not even in theory, but literally, this is your breakaway gap. Right there. Now, look here. This is what's really going to prove my point when I say after it's done with its objective, it'll come back and return to that gap. Let's see when we purge liquidity, that liquidity that I marked. Right there. See that? At what's that? 10:30? 10:36 is when it hit that high. Or 10:35, what do you want to say? But it's basically 10:30. We hit that. Watch what happens. I'm going to pull this gap all the way out. Hold on, just give me a minute. Pull it all the way out. Now we're going to scroll over to the right and watch this. Whoa. Whoa. You see that, right? Yeah, I see it too. Pretty amazing, isn't it? So, since this breakaway gap was within the narrative or in between the narrative of running buy side liquidity, you could possibly say, not even possibly, but you can say, without you sounding crazy, that this gap right here, that gap right there, is a breakaway gap. Why? Because we are rebalancing all the imbalances that are in here and repricing to an equilibrium. Right? Right? Am I wrong? Maybe. Let's see. From here, hold on, let me just gotta use my sniping skills real quick. Okay, boom, there we go. Bam. Look at that. We repriced down into equilibrium, or basically into a deep discount. You get the point. Same thing. In which we are also filling all the imbalances that were in here. You look on the 5 minute or something like that, there's a bunch of imbalances, just a whole lot of them. So that's what's happening here. In which the first gap, even on the 5 minute, we just totally switch time frames. Even on the 5 minute, the first gap that forms is what? A breakaway gap. And guess what? Does it stay open? Yeah, it stays open. Until when? Until, listen here, until when? It's doing two things here. Reminder, it's rebalancing imbalances and repricing to an equilibrium or repricing to a deep discount because they're basically the same thing. I'm going to rule my drawings, right? Tell me when you stop seeing imbalances. Like literally, tell me when you like literally say stop and we're going to see if you get it right. I'm going to keep going down. Ready? 3, 2, 1. Still a lot of imbalances here. Still a lot of imbalances. Oh, stop. Oh, okay. Yeah, you're right. So at that point there, right along here, we can just mark it wherever we want to, right there, is where the imbalances stop. Why? Because this one right here, balanced. That one down there, balanced. So all this little movement right here, it's all balanced. It's all efficient. The inefficient is right here, or the gappy area is up here. So basically, anything above this swing, anything above that swing has imbalances. Okay. And once it reaches this right here, once it reaches this, since that's the second most important out of the three, the most important is liquidity. Second most is the rebalancing imbalances, and the third is equilibrium. Since we are doing the second most important, that's what we need to knock out first, in which we did both at the same time. But you see what's going on here? It's prioritizing rebalancing imbalances, in which after it does that, what does it do? It rallies higher into the breakaway gap that was once a breakaway gap, but is now a gap that can be used regularly. Oh my God. Oh my God. Is this real? Yeah. Yeah, this is real price action. Even in hindsight, this is still amazing. So you're seeing you're seeing what's going on, right? Are you seeing it? Yeah, you're seeing it. Okay, I'm just making sure because these markets are very advanced, and you're learning from a very advanced ICT student. So I'm gonna try to find one more example, and I'll put the little searching for example sequence down here. So give me 3 hours to find one. Okay, I think. And when I say I think I found one. Well, no, not even I think, I did. So here is the breakaway gap. Right off the bat, I know you're like, huh? That isn't what you just taught me. Well, I did say there's 3 to 4 other elements or specifics when it comes to this concept. Since this is a breakaway gap, you remember when I taught you institutional order flow entry drill? Yeah, you see how the teachings are coming in handy now. The institutional order flow entry drill is what? What is it? It's yeah, it's price coming into a gap and not touching the equilibrium. But what is also happening there? What is actually going on behind the scenes? Price is offering a short term, very, very, very short term what? It starts with a R. Rebalance. Very, very, very short term rebalance. Or a not inefficiency, but efficient delivery when it reaches up into this gap. Very, very short term. It's offering that short term efficiency of this gap to balance what? The gap. Duh. Just partially, just for a little bit. Just very, very short term. So it could do what? So it could break away. You see what I did there? Okay, I'm sorry. Let me stop making puns. Anyway, but institutional order flow entry drill can be applied to breakaway gaps. Reminder, if it goes past that equilibrium, this breakaway gap is gone. Doesn't exist anymore. Understand? So applying institutional order flow entry drill and understanding that it's offering very, very, very short term, very, very, very short term rebalance and efficient delivery for the gap just disproves the gap theory. It proves it. That price gives or offers very, very short term opportunities for interbank to transact with each other to offer, not to offer, but to, to build efficient delivery. That's what's going on here. Rise up. Okay, deal. Here, let's make efficient delivery. And then we drop. That's exactly what's going on. It doesn't do it? Yeah, it does. And what are we doing? What are we doing, guys? Do you know? Do you know? Do you know? We are rebalancing imbalances. Oh my God. Oh my God. Oh my God. Now, listen here. From here to here, you're probably like, okay, how do we calculate when price is going to stop? Watch this. Remember when I said the 3 things? Seek liquidity, rebalance imbalances, and rebalance the equilibrium. We did all 3. Once we've done all 3, we're good. Price can stop. In which the final one is the equilibrium. Why? Look here, look here. The liquidity is below these equal lows right here. See that? That low there. I don't know if you can see it, but it's real, real small. I think you can see that low there, and then that low there. So that's the liquidity part. That's the first step. That's the most important. Second is the imbalances, which is all in this run here. The imbalances below these lows. Which what? Oh, yeah, you remember that, right? Whenever there's imbalances below swing lows or below liquidity, price is likely to what? Reach into those imbalances and fill it. Does it do it? Yup. There's the imbalances. There's the fill. Wow. In which, when do we stop filling? Because there's still imbalances down here, but we have to do all 3 if we really, really want to stop. If we just don't want to go any further and come down to these imbalances, if we don't want to, what do we have to do? We have to fill or do all 3 things. And do we do it? Yes. Let's go over it one more time. Liquidity sought. That's number 1. Number 2, seek imbalances. Imbalances over here. We look over to the right. There's the rebalance. And then also, the last thing, number 3, rebalance the equilibrium. Here's the equilibrium. Here's the rebalance. Now let's just draw this over just so you can really see the precision here. Do you see that? Do you see that? Do I even have to like exaggerate this anymore? Do you see that? 8 points? Hey, I don't think the precision can get any better than that. As that's pretty less than 10 points? Me personally, that's it's pretty good. I don't know about you, but that's pretty crazy precision, right? Now watch this. That same breakaway gap, after since we've done all 3 things, we've completed our objective. Guess what price can do now? It can use the breakaway gap. And does it do it? Yes, it does. Yes, it does. Yes, it does. Look, stays below equilibrium. Guess what? Uses it again. See this? You see this? I'm sorry. I'm getting a little too riled up. But do you see this? Do you see this? Let me draw equilibrium for you. Hold on, hold on. Gotta calm myself down because I was getting a little too excited. The precision is too much for me. The precision is like a drug. I'm sorry. Hold on. Let me just do that. You see this? Do you see that? Do you see that? Do you see this? Do you see it? Yeah. Yep. I see it too. And that's why I love ICT Concepts. I love it. I love it so much. I love it. Michael is the GOAT. Well, I don't think he likes being called the greatest of all time, but Michael, you're a very good man. Very, very good man. This precision is off the charts, literally. See what I did there? Sorry. I mean, another fun. Okay, I think this is enough of this, honestly. Let me drop some elements or some specifics before I go. Breakaway gaps are supercharged or are less likely to get repriced into as an institutional order flow entry drill if there is time distortion before it. Okay, I taught this before, but if there's time distortion before it, it's likely that the move is going to be supercharged and the breakaway gap is less likely to get repriced into during the move. Probably said it a little fast, but replay it, slow it down on 0.75 speed. Anyway, that's the end of this fun episode. I really enjoyed recording this and I hope you have fun watching it because this was I definitely had a lot of energy during this episode, but maybe a little too much, in which I'm sorry for that. May seem a little unprofessional because just my tie. Um, I guess I'll see you in the next episode. Good luck and good trading.